On February 12, 2026, the United States Mint made an announcement that stopped the silver community in its tracks. The 2026 Proof American Silver Eagle, set to release on February 26th, will be priced at $173 per coin. Let that sink in. Last year's 2025 version, $95. That's an 82% price increase in 1 year. Now here's where this gets interesting. At the exact same time, the Mint is raising their prices by 82%. The spot price of silver, the price you see quoted on financial networks, is sitting at around $77 to $82 per ounce. Pay close attention to what I just said. The Mint is charging $173 for a single ounce of silver. The spot price says silver is worth $78. That's a $95 premium, or roughly 122% over spot. Think about what that means for a second. If you wanted to buy physical silver right now from the United States Mint, you're paying more than double what the official silver price says it's worth. This is not normal. This has never been normal. And by the end of this video, you will understand exactly why this is happening, what it means for the silver market, and most importantly, what might happen next. But before we dive into the evidence, if you're watching this and thinking, I need to understand what's really happening in the silver market, hit that subscribe button. This channel exists to cut through the noise and show you the actual data. No hype, just facts. Now, let me show you something even more bizarre. Here's what you need to understand. There are two silver markets operating right now. There's the paper market, where silver trades at $77 to $82 per ounce on exchanges like COMEX. And then there's the physical market, where actual metal changes hands. And these two markets are telling completely different stories. Let me walk you through the evidence, source by source. According to the official U.S. Mint announcement on February 12th, the new 2026 Proof Silver Eagle will cost $173, up from $95 last year. That's an 82% increase. The 2026 Congratulations set jumped to $175 from $97. That's an 80% increase. The 2026 10-coin proof set went from $40.25 to $107, a 166% increase. The 2026 uncirculated mint set skyrocketed from $33.25 to $124.50, a 274% increase. Now, the Mint didn't give a detailed breakdown of why. They mentioned silver volatility as a factor. But here's what they're not telling you. Silver spot price on February 12th was $82.49. That's actually down from where silver was trading in mid-January. So if spot silver is lower than it was a month ago, why are premiums exploding? Let's look at what major bullion dealers are charging for 2026 Silver Eagles in brilliant uncirculated condition right now. COMEX is showing pre-order prices at $155 to $163 per coin for quantities under 500. SD Bullion has them listed at $148 to $152. JM Bullion's pre-orders are ranging from $151 to $159. These are all significantly higher than typical premiums we've seen historically. For context, normal premiums on Silver Eagles typically range from $3 to $8 over spot in normal market conditions. Right now we're seeing $70 to $85 over spot on dealer sites. That's roughly 10 to 15 times the normal premium. Now let me show you something from the retail side that's equally telling. According to reports from multiple Reddit threads and dealer forums over the past week, Costco's silver sales, which have been a phenomenon over the past 2 years, are seeing delivery delays stretching into March and April. Several users reported ordering 1-ounce silver bars in late January, with expected delivery dates now pushed to mid-March. That's a 6 to 7 week delay for what's supposed to be in-stock inventory. When you call Costco customer service, they're attributing it to supplier delays and high demand. But here's the question. If silver is crashing on the COMEX and spot prices are down, why is retail demand causing 6-week backlogs? Let me take you overseas for a moment. The Perth Mint in Australia, one of the world's largest government-backed mints, released their January 2026 sales figures on February 3rd. They sold 1.24 million ounces of silver in January alone. That's a 47% increase compared to January 2025, and their highest January sales figure since 2021. Now think about the timing. Silver crashed from $121 to $95 on January 30th, the largest single-day drop since 1980. And yet, physical demand at Perth Mint was soaring throughout that same month. Does that make sense to you? Prices crashing, but one of the world's largest mints seeing near record demand? Let's head over to India, because this is where it gets even more interesting. According to data from the India Bullion and Jewelers Association published on February 10th, Silver imports into India in January 2026 reached 455 metric tons. To put that in perspective, that's barely 1% of annual global silver production of approximately 25,000 metric tons, but it represents a massive surge for a single month. India typically imports 7,000 to 8,000 metric tons per year. If January's pace continues, India alone would import over 5,400 metric tons in 2026, approaching 70% of their typical annual intake in a year where prices supposedly collapsed. Now let's talk about China, because this is critical. On February 7th, reports emerged from multiple Chinese commodities outlets that silver premiums in Shanghai had spiked to $4.50 per ounce over London spot prices. This is significant. Historically, Shanghai silver trades at a discount or very small premium to London, typically in the range of 50 cents to $1. A $4.50 premium means there's extremely strong physical demand in China, despite the paper price crash. What does that tell you? It tells you that Chinese buyers are willing to pay significantly above global spot prices to secure physical metal. Here's something else from China that should make your ears perk up. According to Shanghai Futures Exchange vault data published on February 11th, registered silver inventory in Shanghai-approved warehouses dropped by 127 metric tons in a single week, from February 4th to February 11th. That's roughly 4.08 million ounces withdrawn in 7 days. To give you context, the entire Shanghai Futures Exchange holds approximately 1,200 metric tons of registered silver. Losing 127 tons in a week represents over 10% of total inventory. That's not normal drawdown. That's a run on physical metal. Now let me bring you back to the United States and show you what's happening at COMEX. According to official CME warehouse reports dated February 11th, 2026, COMEX registered silver, that's silver available for immediate delivery against futures contracts, dropped to 98.1 million ounces. Let me say that again so it sinks in. COMEX registered silver is now below 100 million ounces for the first time since 2016. On February 10th alone, there was a single-day withdrawal of 4.7 million ounces. That's one of the largest single-day drawdowns we've seen in years. Here's why this matters. The March 2026 silver futures contract currently has open interest representing approximately 85,000 to 91,000 contracts. Each contract represents 5,000 ounces. Do the math with me. That's 425 million ounces on the low end to 455 million ounces on the high end of theoretical demand for physical delivery. COMEX has less than 100 million ounces of registered silver available. Even if only 25% of those contracts stand for delivery, you're looking at 106 million to 114 million ounces of demand against 98 million ounces of supply. First notice day for March contracts is February 27th. That's 13 days away from when I'm recording this. Now stop for a second. Think about this. The spot price of silver on COMEX says silver is worth $77 to $82. But COMEX warehouses are bleeding inventory. The U.S. Mint is raising prices by 82%. Retail dealers can't keep up with demand. Shanghai is paying $4.50 premiums. India is importing at record pace. Perth Mint had their best January in 3 years. Does any of this sound like a market where silver should be trading at $77? Let me show you another piece of the puzzle. Silver lease rates. For those who don't know, lease rates are what it costs to borrow silver for short-term delivery. In normal markets, silver lease rates sit around 0.1% to 0.5%. According to data from Kitco and Bullion bank reports circulating in early February, 1-month silver lease rates have spiked to between 3.5% and 4.8%. Let that sink in. It now costs nearly 5% to borrow silver for 30 days. Why would lease rates explode if there's abundant silver sitting around? Lease rates spike when there's a shortage of available metal, when people need silver now and are willing to pay a premium to access it immediately. Here's what nobody in the mainstream financial media is talking about. If you look at the COMEX trading data from late January, specifically around January 30th when silver crashed from $121 to $95, something very specific happened. According to analysis from several commodities tracking services, the massive sell orders that triggered the crash occurred almost exclusively during U.S. trading hours, between 8:30 a.m. and 2 p.m. Eastern Time. We're talking about coordinated waves of selling that moved hundreds of millions of ounces worth of paper contracts in a matter of hours. This wasn't retail investors panic selling their 10-ounce bars. This was institutional level activity. Now contrast that with what's happening in Asia and the Middle East. Reports from Dubai gold and silver souks, published in Gulf News on February 8th, indicate that silver demand in January was up 62% compared to January 2025. Dealers in Dubai are reporting that customers are buying physical silver in kilogram quantities, paying premiums of $8 to $12 per ounce over spot. The timing is not coincidental. One side of the world is selling paper contracts during their trading hours. The other side of the world is accumulating physical metal. This is not coincidence. This is a calculated pattern we've seen before. Let me take you back to 1979 and 1980. In September 1979, silver was trading at around $8 per ounce. By January 1980, it had rocketed to $49.45 per ounce. What happened? The Hunt brothers, Nelson Bunker Hunt and William Herbert Hunt, were aggressively accumulating physical silver while simultaneously buying futures contracts. They understood something critical. If you control enough physical silver and force delivery on paper contracts, you can squeeze the market. The COMEX and regulators eventually changed the rules mid-game, implementing Silver Rule 7, which restricted the purchase of commodity contracts and essentially killed the Hunt brothers' strategy. But here's what's important. Before the intervention, the disconnect between paper and physical became so extreme that COMEX almost failed to deliver. We're seeing echoes of that same pattern now, except this time it's not two brothers in Texas, it's entire nations. China's silver imports have been climbing steadily for years. India's jewelry and industrial demand continues to grow. Middle Eastern wealth is diversifying into hard assets, and meanwhile, Western institutions are selling paper contracts on exchanges while physical inventories drain. Read that again. Paper selling in the West, physical accumulation in the East. Here's something else you need to know. According to a report from the Silver Institute published in January 2026, global silver mine production in 2025 was approximately 841 million ounces. Total silver demand, including industrial use, jewelry, silverware, coins, and investment, was estimated at 1.17 billion ounces. That's a deficit of roughly 330 million ounces. Where does that deficit get filled from? Above-ground stockpiles, recycling, and existing inventories. But here's the problem. Those stockpiles aren't infinite. COMEX warehouses are draining. Shanghai vaults are draining. Mints are raising prices because their costs to acquire silver are rising. This is supply-demand economics at its most basic level. When demand exceeds supply, prices should rise. But the paper price says silver is falling. That's the paradox. Now let's talk about what happens next, because this is where it gets critical. There are three types of people watching this video right now. The first type is scared. You bought silver at $100 or higher, watched it crash to $77, and now you're wondering if you should sell and cut your losses. The second type is confused. You're hearing all this conflicting information. Your financial advisor says silver is a barbarous relic. The news says commodities are dead. But you're watching premiums explode and inventories drain. You're paralyzed, not sure what to believe. The third type understands what's happening. You see the disconnect between paper and physical. You recognize that the March delivery deadline could be a catalyst. You're not panicking. You're watching carefully. Let me address each of you. If you're scared and want to sell, understand this. The people buying your silver at $77 spot are often paying $150 to $170 for physical delivery. Ask yourself, who's on the right side of that trade? You're selling at spot, they're buying physical at massive premiums. If you're confused, the best thing you can do is verify everything I've said today. Go to the COMEX website and check registered inventory yourself. Look at the US Mint's pricing page. Check Shanghai premiums. Read the Perth Mint sales reports. Don't take my word for it. Do your own research. And if you understand what's happening, you already know that the next few weeks could be pivotal. Here's my assessment of what could happen next. And I want to be clear, this is analysis based on available data, not a crystal ball. Between now and February 27th, we're going to see if the March COMEX delivery stands firm or if contracts get rolled forward into later months. If a significant percentage of March contracts demand physical delivery and COMEX cannot deliver from registered inventory, we could see several things happen. One possibility is that COMEX raises margin requirements or changes rules to discourage delivery, similar to what happened with the Hunt brothers. Another possibility is that spot prices spike suddenly as physical tightness forces paper markets to reflect reality. A third possibility is that nothing dramatic happens, contracts get rolled, and the market continues this two-tier structure for months longer. What I'm watching closely is the divergence between retail premiums and spot prices. If U.S. Mint premiums at 122% over spot represent true physical market clearing prices, that suggests spot is significantly undervalued. If Shanghai keeps paying $4 to $5 premiums, while COMEX says silver is worth $77, that's a market inefficiency that eventually has to resolve. Markets don't stay disconnected forever. Either physical premiums have to come down, which would require a massive surge in supply, or paper prices have to rise to meet physical reality. One more thing to consider. Industrial demand for silver is not slowing down. Solar panels, electronics, electric vehicles, medical applications, and emerging technologies all require silver. According to the Silver Institute, industrial demand accounted for approximately 508 million ounces in 2025, over 60% of total global mine production. That's not speculation or investment, that's actual consumption. Silver that gets used in industrial applications doesn't come back to the market, it's gone. When you combine structural industrial demand with investment demand from Asia and the Middle East, and you layer on top supply deficits and draining inventories, the fundamentals point in one direction. Now, I know what some of you are thinking. If silver is so tight, why did it crash from $121 to $95 in January? Here's what likely happened, and again, this is analysis based on pattern recognition from past market events. When silver spiked to $121, it triggered massive margin calls and forced liquidations across leveraged positions. Chinese commodity trading firms, who had been using silver as collateral for loans, got hit with liquidation notices. They had to sell contracts immediately to meet margin requirements. That selling cascade fed on itself, triggering stop losses and algorithmic selling. Within hours, you had a flash crash environment. But here's the key. That crash happened in the paper market. The physical market barely budged. Dealers didn't drop their premiums. Mints didn't lower prices. Retail buyers actually increased purchases. The crash in paper didn't translate to a crash in physical. Think about what I just described. That's not how normal markets work. In a normal market, when the price of something crashes by 22% in one day, demand dries up. Nobody wants to catch a falling knife. But in silver, the opposite happened. Physical demand surged as paper crashed. That tells you everything you need to know about which market is real and which one is artificial. So where does that leave us today, February 14th, 2026? It leaves us with the U.S. Mint charging $173 for silver that COMEX says is worth $78. It leaves us with Shanghai paying $4.50 premiums while spot is supposedly crashing. It leaves us with COMEX inventories below 100 million ounces and a March contract representing over 400 million ounces of potential demand. It leaves us with lease rates at 5%, which screams shortage, while spot prices say there's abundance. None of this makes sense unless you understand the two markets. Here's what they're not telling you. They're not telling you that the paper market and the physical market have completely divorced. They're not telling you that COMEX might face a delivery crisis in 13 days. They're not telling you that the 82% price increase from the U.S. Mint isn't random. It's a reflection of what physical silver actually costs to acquire right now. They're not telling you that while Western banks were slamming silver down to $77 on paper, Eastern buyers were backing up the truck to load physical metal at those prices. If you found value in this video, do me a favor. Hit that subscribe button and turn on notifications, because the next few weeks in the silver market could be historic. Drop a comment below and tell me what you think happens on February 27th when March deliveries come due. Do you think COMEX delivers? Do you think they change the rules? Or do you think contracts get rolled and we kick the can down the road again? I read every comment and I want to hear your perspective. One final thought. Whether you own silver or you're just watching this market out of curiosity, what's happening right now is a lesson in how markets actually function versus how we're told they function. We're taught that prices reflect supply and demand. We're taught that markets are efficient. We're taught that arbitrage opportunities get exploited away instantly. But when you can buy paper silver at $77 and the same ounce in physical form costs $155 to $173, something fundamental has broken. Either paper is too cheap or physical is too expensive. They can't both be right. And eventually, reality wins. It always does. The only question is when, and who's positioned correctly when it does. That's it for today's video. Stay informed, verify everything, and I'll see you in the next one.